You guys know by now, if you have any chance of making it in the Forex game, you must have rock solid money management and rock solid discipline. Now, a risk-reward ratio like a 2-to-1 or a 3-to-1 actually gives you both. Do I recommend you use them? No. And I don't think I stressed that no loud enough. No, do not use ratios in your trading. There's the short answer. But as you guys know by now, you want to stick around for the long answer because there's a lot of gold in this video, a lot of really, really great takeaways. Even though it's something a little more kind of Forex 201, a little more advanced than what I've been talking about before. So you see the ratios is in green. It is an important part of the money management playlist that I've put out. A playlist that, by the way, has been more responsible for taking traders' accounts and flipping them from negative to positive than anything else I've ever done. Why? Because money management is everything. Without it, you're lost. You have no chance of winning. With it, and with good money management, rock solid money management, you can move mountains. There is no limit to what you can do, and we are going to see examples of that in this video. So in this video, I'm going to explain to you why ratios, like your more common ones, the 2-to-1, 3-to-1 trading ratio, and any other type of trade management ratio out there is a bad idea. I'm going to go over what these ratios actually are and what they do, and show you how a lot of people will use them, and also explain to you why it's so foolish for them to do it that way. But there's a lot of lessons within me telling you how bad these things are. So I want you to catch up before we get started. I should have mentioned this. This, like I said, is a little more of an advanced concept. This is a video in a sequence, and it's my money management playlist. If you haven't caught every video in it, I want you to start at the beginning of it. I'll link the playlist down below, and when I tell you to pause the video and go watch it. If you're really in this, if you really want to become a great Forex trader, you have to study these videos before you get to this video here. It just makes sense. And you should want to. I mean, the amount of traders I've already taken from negative to positive in their trading has been phenomenal, and it's all been because of this playlist. Not my indicator videos, not anything else, the money management playlist. That should be so exciting that you would want to stop the video right now and go start on that playlist immediately. But I also want to make sure you watch the Big Banks video. Pretty much everybody who has subscribed to this channel at some point has seen the Big Banks video, and it has been transformative. There are Forex traders out there that have been at this forever, 10, 15, 20 years trading, that still have the wrong idea of who moves price up and down. They think it's sentiment-based. They think it is based on things like the RSI. They are wrong. You get the chance in one video to completely have your eyes opened and vault ahead, knowledge-wise, of people who have put that much time in. Really, that video alone, you won't have to worry about getting on their level. They'll have to worry about getting on yours. Because if you just understand who makes price move up and down and why, you will have a base, fundamental knowledge of Forex that almost nobody else has. People who work at high-end trading firms, most of them don't know this. A lot of those people you see on YouTube that have millions of views that seem super smart in their videos, they don't know this. Guarantee you that. You can vault yourself ahead of these people in a very, very short amount of time just by watching the money management playlist and the Big Banks video. And it's going to set you up for this video really, really well, to where you're actually going to understand all of it. So why wouldn't you hit the pause button right now, go down below in the description, and watch these videos. For the rest of you, thank you for being patient. We move on. Understand what these are and what I'm going to be hinting at going forward. This is not a take profit video. That video is coming, and it's probably going to be more than one. That's why I put this little parentheses S in place. But I'm going to hint at some of these and kind of give away what some of these videos are going to be about in this video here. Also, you guys know my methodology by now. I always tell you what to avoid first before I tell you what to actually do. So don't get antsy and get upset that I'm not giving you an actual take profit framework. I'm going to give you a little bit of one in this video, but this is not the take profit video. That is coming, and it's going to come relatively soon. I'm not going to make you wait too long for it. But before I gave you an idea of what indicators you should be using, for example, I told you a bunch of them that you should not be using, and I told you why. Because I wanted to get you out of that headspace first. I wanted to get you so anti-indicators and tools like that no matter what happens from this point forward, you will never go back to that way of thinking. And this is a video that falls into that avoidance category. But again, I'm telling you, I think you're really going to like some of the takeaways in this video here. Now, common ratios, you have to know what they are. 2 to 1 and 3 to 1 are the most basic. And what this means is you're going to take profit at 2 times or 3 times, depending on what the ratio is, of wherever you put your stop loss. So let's say your stop loss is at 80 pips. If you have a 2 to 1 ratio, it's pretty much just going to be this race to where price is either going to make you 160 pips or it's going to lose you 80 pips. So with a 3 to 1 ratio, it would be 240 pips before you lose 80 pips. And people think by doing this that they, even if they take some losses, they're really putting the odds in their favor. And they are doing anything but. Now, I realize there's variations on these ratios to where you take some off here, blah, blah, blah. But the most common way people do this is very simple, very crude. It's either going to be on a 2 to 1 ratio, either I'm going to make 160 pips or I'm going to lose 80. There's no in between. And look, it gives you some kind of money management, some kind of discipline. It's better than nothing. I mean, not much, but at least you have something. I guess that's good. Your head's in the right place. Most people don't even have that. But if you think this is going to make you win long term, it's not. Get used to eating one piece of broccoli, because that's really all you're getting. Now, as for the rest of us, we need to understand why these one piece of broccoli eaters are doing it wrong. The first mistake that they make, and this is the way that I've seen most people who use a ratio choose to approach it. They do it by figuring out where their take profit is going to be first. And they do that by figuring out, all right, do I have a support or resistance line coming up? Do I have a pivot point line coming up? Do I have a Fibonacci level coming up? One of the tools in the Dirty Dozen video, which if you guys have watched that video, you know how useless and silly those tools even are. Pivot points I don't think were in there, but they easily could have been. I'll make a video on that sometime down the road. But most traders use technical tools like this. I guarantee you a lot of you who have put a little bit of time in Forex probably did before you saw that video. So just understand how common it is to do it that way. Let's go ahead and go to my charts, and I will show you an example of this because I think you need a visual in order to really understand what I'm talking about here. So here we are at the Euro-Dollar daily chart, a very common one I use because I don't like to cherry pick. And I did go back a little bit because there's a really good support line example here. Now, so price ran up and then kind of consolidated a little bit. And what happened is this line, the support line came about. And people probably started drawing it right here when this swing low came down. And what they had noticed is price had a hard time breaking that line. You noticed here, almost broke it for a second, but came back up. Couldn't really get any kind of follow through past this line. And then it didn't quite get there here, and then there it bounced off of it again. How about that? Now, those of you who have watched the big banks video and understand how the big banks work have a pretty good idea of what happened right here. Huh? A lot of people, or most people, are reversal traders, right? We already know that. That was in the reversal versus trend video. So suffice to say, they were probably waiting for price to bounce off this, which means they wanted to go long. When they did that, they put a stop loss right down here somewhere. And the bank said, well, yeah, I do want to take this long, but I'm not going to reward all those people who are trying to get this bounce. And they took that stop loss out. And only then did they say, okay, now it's time to go longer. That's exactly what happened here. You can draw these support and resistance lines anywhere you want. You will see this phenomenon happen over and over and over. But moving on, in the mind of most traders, this was a great support line because it hit it here, it couldn't break it here, Didn't quite get there here, but then it bounced off of it again. I mean, we really have something we can use, right? So you would like to go short right at this nice little bearish bar right here. And so this is what most people do. They say, okay, I will trade all the way up to that support line because that support line is pretty rock solid. So let me see what the distance is from where the candle closed to the line. Move it over here so you can see it. Sorry, guys. About 70 pips, right? So I'm going to set my stop loss at 35 and my take profit at 70 pips. That is a 2-to-1 ratio. And that's how the majority of traders who use ratios will figure their actual ratio, their take profit to stop loss. They'll look at the take profit first and then figure out the stop loss from there. So your everyday trader who thinks they're super smart went ahead and did that, and that trader made 70 pips. Fantastic job, Johnny Everyday Trader. You did, because price made it to that support line. Problem was, it went a lot farther than that. Oh, did it ever. Look at this. Went pretty goddamn far. Let's see. Let's see what the actual top to bottom optimized amount of pips would have been. So you got your 70 and you stopped there and you moved on. And you passed up on about 700 pips worth of profit. You know, realistically, probably closer to 600 because you would have gotten out somewhere there, maybe there. But yeah, you really shut the door on all of this. So nice job. You have money management. You have discipline, I guess. You just don't have a lot of profit. And that's kind of the end game, isn't it? Lines like this are only valid until the banks decide they're not anymore. And then, whammo. Now, I guarantee you there wasn't anybody using this line for breakouts, for trends, because fail, fail, fail. You give up after a certain time. And the banks know that. The banks know people have just given up on trying to call breakouts on this line, and they're only looking for reversals. And when they know that is when they decide, okay, guys, price is officially going to trend. So using these lines to figure out your ratios is already foolish on so many levels. Even having the ratio in the first place is the wrong way to go. And let's explore further why that is. So we've already gotten a little peek inside how most of your dumb jabroni traders actually use these ratios. And it's a bad idea always, but the other things that it prevents are the most important things I want you to take away in this video, because they are things that we will make sure we participate in and we take advantage of. And you can't do that with these ratios. The second one is not scaling out. Scaling out was going to be its own video. It probably still is. But I can't go any further with this video unless I explain to you what this is and how it applies. So if you didn't know, and this is not me giving you a framework, this is just an example, okay? This is not me telling you what to do. But let's just say you take any pair and say, all right, 80 pips is my take profit level. But what I'm going to do is when it hits 80, I'm only going to take half my trade off. And then I'm going to take that stop loss that was at, maybe minus 40 pips, minus 60 pips, whatever. I'm going to move it up to break even. I'm going to move it up to where I actually went long or went short. Now, by doing this, I'm going to make sure that I can no longer lose. It's just a matter of how much I win. I'm going to hope this sucker runs. Now, a lot of times it's not going to do that. A lot of times you're going to take half off at 80 pips, move your stop loss to break even, and then it's going to come back and hit that stop loss. So overall, you would have netted 40 pips because 80 plus 0, is 80, and then you divide that by 2, that's 40. That's how you figure that out. And that's a small win. Wasn't what you were hoping for, but this is a good thing. Let me explain why. Because when you scale out like this, you make it so there's no way you can lose. It's only now a matter of how much you can win. Now, like I said before, often at times, these wins are very small because price will come back and hit that break-even stop loss. It happens more than it doesn't because that's just how the market is. It moves in waves. It moves up and down. But the thing about it is, when you rack up these small wins, what they do, and all you want them to do, is negate the losses you've taken. At the end of the day, you want to take your losses, and you want to take these small wins, and just hopefully break even. End up at zero. End up at a clean slate. You might be sitting there thinking to yourself, now, VP, why would I want to do something like that? The point is to make money. The point is not to break even. Well, my friend, my misguided friend, that is where the third point comes in. It all ties together. The third big mistake that people make, and probably the biggest one of the three, when it comes to only trading at a 2-to-1 or 3-to-1 ratio, and you've already seen an example of it, they cap their upside. Why on earth would you want to put a cap on what your upside is going to be? Guys, there are 700 pip, 1,000 pip, 1,500 pip trends out there on all different currency pairs that happen more than once every year. So you're going to tell me by having a 2-to-1 or a 3-to-1 ratio that you don't want any part of those. You don't want all those pips. Somebody else can have them. Well, that somebody else is me, because I'm going to take them. I am a trend trader. And at this point, I hope you guys are trend traders too. Those runs are what we live for. And here is why. Never cap your upside, because you want those big runs. Because what's going to happen if you do the other part right? If you allow all those little small wins to rack up and cancel out the losses you take, so you end up at break even, no losses, no gains, what will happen is when you get those trends, when you get on board with them, that's what actually goes into your pocket at the end of the year. Those really long, beautiful trends, you get to have all of it. Now, I realize since you already took half off, you get a 700 pip run, for example, that you're only getting 350 pips of that. But that's fine. That's 300 to 350 pips of pure profit in trends that repeat themselves over and over as the year goes on. You can probably count on 2 or 3 of those really good runs per currency pair. I trade 27 currency pairs, and I have gotten it to where I can participate in the majority of those nice long trends. And because my smaller wins negated my losses, all those trends are pure, unadulterated profit. You want to see how this plays out on my charts? I'm sure you do. Let's go look. So for fans of the channel, these are 2 familiar sites. First off, we are going with the pound Swissy. Like, oh, VP, you're cherry picking. No, I am not. I have mentioned in a previous video that this is one of my absolute favorite pairs to trade, and you should be trading pairs like this far more often than you should dollar pairs, for example. So if you do that and you put yourself in the best situation to win, you're going to win more than you're going to lose. And I want to illustrate that here. And you can do that just even with a so-so indicator like the Arun up and down, which you've also seen before. Now, those of you who have not, here's how it works. You are waiting for these lines to cross. Green is long, red is short. And when they cross, you want the one that is going higher. So in this case, the red is going higher when it crossed. That's going to be a short signal. And over here, the green is crossing higher. That's going to be a long signal. So let's see how we do on this pair just with an indicator that I don't even recommend you use, just a basic everyday trend indicator. Let's see. So let's just take those 80 pips. Let's try to get an 80 pip profit so we can bank half of our trade on the 80, move our stop loss to break even, and then see what happens. So we'll even start at what looks to be a loss. So we'll go here. Did we get 80 pips? No, we did not. That's going to be a loss in some capacity. So the very next trade was this short, because you can see the red line is crossing upward. Now, where did that officially happen? Looks like this here. Did we get 80 pips at any point? It looks like we did. Okay, so we'll bank that as a small win. Let's see where our next signal is. Looks like it's right here. It's going to be a long because the green is crossing up. And it would have gotten us in at this candle here. Did we get 80? Sure did. Now, none of these were the trends we were looking for, but they give us those small wins that would have negated the loss we took back here. See how that works? And so hopefully at that point we end up at 0 pips of profit and 0 pips of loss. Break even as close as we possibly can to it, because then what happens is we take this trade right here. Arun says go short right at this candle. And since we started at 0, what does that give us? We took about 80 pips of profit off. Where? Right there. Put our stop loss to break even. We hope it didn't hit it. If we were smart and we entered it the right way, price did not hit our stop loss, and it just kept on running all the way down. Is that 500 pips of profit? Maybe you took off more over here when price retraced. 350 pips of profit. All day. All day. And guess what? I didn't even mention the trend right here. That's a big one. Let's go back. Got this really long one here. If you do stuff right, I don't know why I did that. Oh, I know why. If you do this right, all of these trends go right into your pocket. And this is one currency pair, guys. Who wouldn't want this? How do you make sick returns in the Forex market to where you can actually compound that interest and then retire on it one day? How do you put up the type of numbers that a prop firm or any kind of trading firm would look at and say, I want that guy on my team? This is how. This is how you do it. I have taken this little nugget and I have buried it in a money management video that I know for a fact a lot of fake traders, a lot of people who are not my real killers, are going to probably skip over. And I hope they do, because this right here was a huge secret I just unlocked, and you guys who stuck around just saw it. So in conclusion, just don't use ratios like the ones I showed you ever. Don't ever take that approach. Like I said, it's better than nothing, but man, are you really preventing yourself from having any chance to win in this game. Don't take profit at major support and resistance levels. If that idea ever comes into your mind, just don't. Just do it a different way. I'm going to give you a structure for that soon. But have a plan that involves scaling out as well. Like I said, too, I'm going to have an entire video just dedicated to how to get to that first take profit point and what to do from there. But I'm going to tell you right now, it involves scaling out in a very similar manner to what I just showed you. So you already have that under your belt. But never, ever cap your upside. We are trend traders here. We are not reversal traders. Reversal traders are suckers. They never win. We are trend traders. We want trends. When a trend presents itself, don't say, no, I don't want it. Take advantage, because that is what goes into your pocket. And the more trends you open yourself up to and the longer you're able to stay in them, the more money that becomes. Now, all of this being what it is, you're really going to want to see the scaling out video and all the take profit videos that are coming up, and you're not going to want to miss any of them. So if you're not subscribed already, subscribe. Hit that bell to make sure you don't miss anything I have coming out. I unlock some type of pro tip in some way or another every single video and every single podcast I make. That's the point of why I do these. So it gives you at least one thing that you can take with you, plug it into your trading, and immediately become worlds better than you were before you saw the video. So just imagine if you were to watch 20 or 30 of these. What would your trading look like? What could you become? Hit subscribe, hit the bell, put in the work, and get ready for some more videos. Let's go get it.